Imagine for a second, right? You're standing on the outskirts of this rapidly expanding city in a developing nation.
Okay, setting the scene.
Yeah, and you're watching an absolute economic miracle just unfold right in front of you. Like they are building massive new factories, pouring the concrete for highways that stretch all the way to the horizon, and millions of people are literally being lifted out of poverty.
Right, entering the global middle class is huge.
Exactly. It is, by all traditional metrics, this incredible success story. But then you look up.
And the sky is just thick with that yellow-gray smog.
Yeah. The local rivers are running these unnatural chemical colors. I mean, the carbon emissions from this boom are absolutely skyrocketing.
It is arguably the defining tension of our modern global economy.
Right.
Because economic progress in low and middle-income countries over the last few decades
Right.
has undeniably brought massive prosperity.
Right.
People are living longer, healthier lives, better access to goods. But that progress has almost always been chained to severe environmental degradation.
Okay, let's unpack this. Because it's like we are watching a global seesaw. On one side, you have this desperate, totally valid need for economic prosperity and development.
Absolutely.
But on the other side, you have catastrophic environmental consequences.
Mhm.
And right now, middle-income countries are actually the main source of growth in global emissions. Which brings us to the core mission for today's deep dive. Can foreign corporate money actually balance that seesaw?
That is the million-dollar question, or I guess the multi-billion-dollar question.
Yeah.
When rich countries pour money into developing nations, what economists call foreign direct investment, or FDI,
Right.
what actually happens to the environment?
Well, we have a really fascinating 2026 academic paper in front of us titled Green Gifts from Abroad, FDI and Firms' Green Management by researchers Kanin, Semrau, and Steglick. And they're trying to figure out if this foreign investment acts as a green gift that helps save the planet, or if it just creates a pollution haven. And I'll admit, my initial assumption is that big multinational corporations just move their operations overseas, specifically to escape strict environmental rules back home. Like they just want to exploit weaker laws.
Well, that is the conventional wisdom, right?
Yeah.
It's a super common assumption. You picture a massive corporation fleeing strict regulations just to dump waste in a river somewhere else.
Yeah, exactly.
But the data we're looking at today reveals a much more nuanced reality. Because the researchers didn't just look at macroeconomic trends. They went into the weeds of corporate management using this incredible data set, the World Bank Enterprise Survey.
Okay, how big of a survey are we talking about here?
Massive. We are looking at over 18,100 private firms
Oh, wow.
spread across 31 different countries. Specifically, they focused on regions undergoing heavy transition, so Eastern Europe, Central Asia, and North Africa.
Right, okay.
And the researchers were hunting for two very specific, tangible indicators of green management within these companies.
Which is important because what does it actually mean to go green in a developing nation? I imagine we aren't just talking about a company putting like a blue recycling bin in the employee break room and calling it a day.
Far from it, yeah. They looked for structural commitments. So first, does the firm have a formal green strategy? Meaning, do they have explicit strategic environmental objectives written into their actual business plan?
Okay.
And second, do they employ a green manager? This is someone explicitly hired, on the payroll, dedicated to overseeing climate issues, auditing supply chains, monitoring emissions, that sort of thing.
Which requires real budget. I mean, saying you have a strategy is one thing, but hiring a dedicated executive to monitor your greenhouse gases means you are actually allocating capital to this.
Precisely.
So when the researchers took these 18,000 firms and separated the foreign-owned ones from the purely domestic local ones, what did the World Bank data actually show?
Well, the contrast is striking. So they defined a foreign-owned firm as one where at least 50% of the equity is held by foreign investors. And they found that these foreign-owned firms are substantially greener. Specifically, they are 1.4 times more likely to have a green strategy in place.
Wait, really?
Yes, and 1.3 times more likely to employ a dedicated green manager compared to purely domestic firms.
That's a huge difference.
It is. And the trend actually scales. If you isolate the firms that are 100% foreign-owned, meaning the multinational has total control, those likelihoods jump even higher.
Wow.
So the larger the stake the foreign investor holds, the more likely the facility is to have rigorous environmental management.
Okay, I have to play the skeptic here. Why are they doing this? Like, are we supposed to believe these massive multinational corporations are just acting out of the goodness of their hearts when they set up a factory in North Africa? Because that feels incredibly naive.
It does, and it's not about altruism.
Let me run an analogy by you. Is this less about altruism and more like a corporate operating system? Like when a massive global company sets up a new facility, they just install their default corporate software across the board.
Okay, I see where you're going.
And that default software just happens to include green management protocols, simply because standardizing their global operations is actually cheaper and easier than inventing a brand new, dirtier process just for one specific country.
That is a really solid way to think about it.
Mm-hmm.
But the reality is even more pragmatic than just standardizing software. The researchers explain this mechanism using two core economic concepts:
Why I'm on me.
the resource-based view and institutional duality.
Okay.
Let's take the resource-based view first. Think about the physical reality of going green. It is expensive.
Yeah, very.
Hiring a specialized manager, overhauling a factory's energy grid, or installing emission scrubbers, all of that requires significant upfront capital.
Capital that a local, purely domestic firm probably doesn't have just lying around.
Exactly. Domestic firms in these developing regions often face severe credit constraints. If a local entrepreneur in Central Asia wants to make their textile plant eco-friendly,
It's like getting the loan.
right, local banks might charge exorbitant interest rates,
Right.
or simply refuse it because environmental upgrades don't offer an immediate short-term return on investment. They literally cannot afford to go green.
But a foreign subsidiary can?
Yes, they have the backing of their parent company's deep pockets. They have access to cheap global credit. They actually have the financial resources to execute a green strategy.
Okay, so the multinationals have the cash. But just having the cash doesn't explain why they choose to spend it on the environment instead of just, pocketing the extra profit.
True.
That brings us to the second concept you mentioned, institutional duality. What does that mean in practice?
Institutional duality means that a foreign subsidiary is essentially answering to two different bosses. They're operating in two very different worlds simultaneously.
Okay.
Yes, they're physically located in a host country, and legally they only have to comply with whatever local environmental regulations exist there, which might be super weak.
Right.
But they're also deeply imbued in the parent company's global network.
So they have to answer to the home crowd.
Exactly. They have to answer to eco-conscious consumers, strict government regulators, and NGOs back in their home country.
Makes sense.
Let's say a European manufacturing company opens a subsidiary in Eastern Europe. If that subsidiary gets caught dumping toxic chemicals into a local river,
Someone takes a video on their phone.
yes, it goes viral on social media, and suddenly the parent company is facing a massive PR disaster. Their stock price in Frankfurt or London drops. Consumers start boycotting their products.
So they have to behave.
The multinational is forced to export their strict home country management practices simply to protect their global reputation. It's defensive management.
Okay, that makes perfect sense.
Right.
The pressure from the wealthy home country forces the company to maintain a baseline of decency abroad. But here's where it gets really interesting and where I'm seeing a massive contradiction.
Oh,
Yeah, because at the very beginning of this deep dive, we established that middle-income countries are currently the biggest source of rising global emissions. If foreign investment is this powerful conduit for green practices and multinational money automatically brings these high-end standards with it, why are emissions still skyrocketing in these regions? There has to be a catch. The data can't just be purely positive.
you are absolutely right to spot that contradiction. And this is where the paper's findings get incredibly nuanced. Because the researchers didn't just look at all these firms as one big monolith.
How did they break it down?
They split the data based on the income level of the host countries. And they discovered that this green gift from abroad only functions under very specific economic conditions.
Meaning?
The positive transfer of green management practices only happens in high-income and upper-middle-income host countries.
Wait, so what happens in the poorer nations?
In lower-middle-income countries, the positive effect of foreign ownership completely vanishes. Like, it disappears statistically.
Seriously.
Yeah. In those poorer nations, a foreign-owned firm is absolutely no more likely to have a green strategy or a green manager than a local domestic firm.
It sounds like trying to install cutting-edge 2026 software on a computer from 1998. The hardware just can't run it.
That is exactly it. Economists call this the host country's absorptive capacity.
Absorptive capacity.
Right. It's the idea that for a country to actually absorb and utilize advanced foreign management practices, they need a foundational infrastructure already in place.
Give me a tangible example of what that looks like on the ground.
Okay, imagine a multinational wants to install a state-of-the-art energy-efficient manufacturing process in a lower middle income country.
Okay, they've got the money.
They have the money, but they realize the local universities don't offer degrees in environmental engineering. So there's literally no one to hire as the green manager.
Oh, wow.
Furthermore, the local power grid might be so unreliable that the new efficient machinery keeps breaking down, and there are no local suppliers who sell the necessary replacement parts.
So you're just stuck?
Yeah, the institutional framework, the local managerial skills, and the baseline of educated workers just aren't there.
So the environment in the host country dictates whether the green strategy can actually survive the trip across the border. It's not just about wanting to be green, it's about whether the local ecosystem can support it.
Yes, and that lack of absorptive capacity creates massive friction. Operating in a foreign country is already inherently difficult, right?
Sure.
You don't know the local culture. You have to navigate unfamiliar bureaucracy, build trust with suppliers from scratch. The researchers call this the liability of foreignness.
Okay.
In an upper middle income country, a multinational will spend the extra time and money to overcome that friction because the local environment is developed enough to eventually support them.
But in a lower middle income country.
In a lower middle income country, the friction of trying to force a sophisticated green strategy into an environment that lacks basic infrastructure is just too costly and too exhausting.
Yeah.
And this is where the dark side of globalization creeps back in. When the friction becomes too high and the local environmental laws are incredibly weak, companies succumb to what is known as the pollution haven effect.
So they just give up. They abandon the green protocols entirely.
Often, yes.
Yeah.
The parent company realizes it is too expensive and practically impossible to maintain their home country standards.
Wow.
So they prioritize cost savings, they take full advantage of the lax local laws, they ditch the green manager, and they operate just as dirtily as the local domestic firms. The friction degrades their good intentions.
That is a deeply sobering reality check. I mean, it really emphasizes that the destination of the foreign money matters immensely. You can't just throw cash at a region and expect it to magically become eco-friendly without an educational and infrastructural foundation.
Exactly.
But let's look at the other side of the transaction. We've talked about where the money goes. What about the source of the money? Does it matter who is writing the check?
It does.
Like, does a dollar coming from a famously eco-conscious country act differently than a dollar coming from a country with zero environmental laws?
It matters tremendously, and the data backs this up.
Mm-hmm.
But measuring it was actually quite tricky for the researchers.
Why is that?
Because the World Bank Enterprise Survey didn't explicitly list the specific origin country for every single foreign investor.
Oh, that makes it tough.
So to figure this out, they had to get creative. They took the foreign direct investment stocks in these host countries and cross-referenced them with the Environmental Performance Index, or the EPI, of the investing countries.
What exactly is the EPI measuring?
The EPI is a comprehensive global index that ranks countries based on their environmental health and ecosystem vitality.
Okay.
It looks at metrics like air quality, waste management, emissions, water sanitation. For context, a country like Denmark consistently ranks at the very top of the EPI as a global leader.
So the researchers essentially weighted the investment money based on how green the home country was. Like, if a lot of money was coming from Denmark, they tracked that against money coming from a lower-ranked nation.
Yes, and their third major finding is what we can call a corporate halo effect.
A halo effect.
Yeah, they discovered that the greener the home country of the foreign investors, the significantly more likely the host firm is to adopt green management practices.
So the environmental culture of the investing country literally travels with the money.
Exactly. If a host country in Central Asia receives the bulk of its foreign investment from highly ranked EPI nations,
Like Denmark.
right, countries with strict environmental regulations and intense cultural expectations around sustainability, that green corporate halo extends across the borders.
Yeah, makes sense.
The parent companies in those green nations simply will not tolerate dirty practices in their overseas subsidiaries, and they actively transmit their home country standards abroad.
How do they do that?
They send auditors, mandate specialized training programs, tie executive bonuses to environmental metrics. It is a direct transfer of culture and expectations.
It's fascinating because it means you aren't just exporting capital, you are exporting your domestic values. But I want to challenge this one more time, specifically looking at the types of companies we're talking about, because the paper mentions this effect isn't uniform across the entire economy. It's heavily concentrated in the manufacturing sector.
Yes, it is.
Why is that? What if an international bank or a massive European accounting firm opens a branch office in Cairo? Do they care about hiring a green manager? Because that seems like overkill.
What's fascinating here is that the data perfectly reflects your skepticism.
Oh, really?
Yeah, the researchers found that the positive relationship between foreign ownership and green management is driven almost entirely by the manufacturing sector.
Oh,
When they looked at service firms, like your example of a bank or an accounting office, the green gift effect was statistically insignificant, even for the largest multinational service firms.
why the huge divide? Is it just because an accounting firm's biggest environmental crime is maybe leaving the lights on overnight, whereas a factory is actively burning coal and pumping out wastewater?
The environmental footprint is definitely part of it. Manufacturing is vastly more energy dependent, so the financial incentive to install complex green strategies, which often focus on increasing energy efficiency and reducing expensive waste, is much higher.
Right, that makes sense.
But it also comes down to how these different sectors are structured. Manufacturing relies heavily on economies of scale and standardized, centralized command structures.
Meaning, if they figure out a better way to do something, they force everyone to do it.
Right. If a multinational auto manufacturer invents a brilliant new way to reduce energy consumption on the assembly line at their headquarters in Germany, they're going to mandate that exact same process in their factory in Eastern Europe.
Because it's all the same machinery.
Exactly. The machinery is the same, the process is the same, the rules are the same. But service firms operate very differently. They're much less centralized.
Oh, I see.
A banking branch in Cairo operates quite differently from a branch in London, right? They're tailoring services to the local market. Because they rely less on rigid, standardized physical processes, their operations just don't demand the same level of rigorous, centralized environmental oversight.
So, what does this all mean for you, the person listening to this deep dive right now? Like, why should you, sitting at your desk or commuting to work or making dinner, care about the internal management strategies of an automotive factory in Eastern Europe or a textile plant in North Africa?
It's a fair question.
It matters because this isn't just abstract economics, it's highly personal. Every single time you check the label on your shirt and see where it was made, every time you buy a product that was assembled in a global supply chain, or every time you look at your 401k and realize your retirement fund is invested in an international index, you are participating in this exact flow of capital. You are the source of that money.
And you are the source of the pressure.
Exactly. The environmental standards of your country are being exported through that money. When we talked about institutional duality, the idea that these companies are terrified of a PR disaster back home, you are the home crowd. You are the stakeholder they are afraid of upsetting.
If we connect this to the bigger picture, the key takeaway from this 2026 research is that foreign direct investment is not a monolith.
Right.
It isn't inherently a hero that automatically saves the environment, but it also isn't inherently a villain that only seeks out pollution havens. FDI acts as a conduit.
A pipeline.
Exactly, it's a pipeline. It transfers the green standards, the financial capital, and the managerial expertise of the wealthy world to developing nations. But that pipeline only flows if the receiving end has the plumbing, the economic and educational foundation, the absorptive capacity to actually handle the pressure.
Which brings us right back to that global seesaw we talked about at the beginning, balancing economic growth with environmental survival. And it leaves us with a really provocative thought to chew on.
What?
Well, for years, eco-conscious consumers in the West have debated boycotting products made in developing nations with poor environmental records.
Oh.
It feels like the moral choice, right? We think, if I don't buy this, I'm not supporting pollution.
Sure.
But based on this data, if we now know that foreign investment from green countries actually improves the environmental practices of factories abroad, at least in middle-income countries, does boycotting actually do more harm than good?
That's a fascinating point.
Could financially isolating those developing nations actually deprive them of the exact green gifts, the capital, and the managerial expertise they desperately need to clean up their own environments? It's a really complex reality, because sometimes the best way to clear the smog isn't to walk away, but to invest more deeply in the solution.